want an exposure to a market or an
Everything they need in one place.
The world's foremost authority on individuals, advisors and institutions.
Hello and welcome to Morningstar. I'm Emma Wall, and here with me today is Justin Onakosi, manager of the multi-asset funds for Legal & General, to give me 3 investment tips. Hi Justin.
Hi.
So first up, you've got an investment opportunity for us today, haven't you?
Yes, so in terms of the opportunities across the world, in terms of the universe of assets that I can invest in, there is one asset class which stands head and shoulders above the rest from a risk-return perspective. That's UK direct property. The funds that we manage are typically index funds. However, we can go active if there's an asset class which is particularly attractive for our funds. UK property is one of those asset classes. It doesn't lend itself to passive management. It has to be really managed actively. So why are we positive on UK property? Well, first we became positive on UK property in early 2013. Why? We saw increased income growth in both primary properties, but also secondary properties. Importantly as well, we also saw a pickup of transactions both inside London, but most importantly outside of London. So the growth of secondary and properties outside of London gave us the confidence that this property recovery was widespread. Now, property tends to perform well into a recovery, and we're very much in that expansion phase at the moment. Last but not least, property yields a decent amount for the risk that you take. So if you look at the IPD index, you're talking about 4.6% yield. And in this low yielding world, that is particularly attractive.
I think investors often confuse commercial property with residential property. There's so much in the news about residential property, government initiatives, rising house bubble. Are we in a bubble? Are we out of a bubble? But you're talking about commercial property here, aren't you?
Yes, definitely talking about commercial property. And if you look compared to 2006, where we are in terms of value now, outside of London, we're still 65% of the levels we were in 2006. So, and inside London, we're kind of 90% of those levels. So there's still, for us, a lot of kind of legs, so to speak, in this property recovery.
And what's your second opportunity today?
Second opportunity is emerging markets. It's been quite a contrarian position when we first launched the funds over a year ago. However, it's starting to become more consensus now. Emerging markets, what's so good about them? Firstly, they've got flexibility over both fiscal and monetary policy. Emerging markets didn't borrow as much in the good times, so they don't have the debt accumulation that you see in developed markets, number one. Secondly, they've got flexibility over monetary policy. If there is a global shock, which we're not expecting, but if there is a global shock, emerging markets still have the flexibility to use conventional monetary policy, so to reduce rates. Developed markets, if you look across developed markets,
nowhere left to go.
Exactly, rates are on the floor. So there's not really much they can do in terms of conventional monetary policy. In addition, you've got better demographics in emerging markets, increase in labour force, increase in middle class. They typically don't have the same pension issues that you have in the developed world. Last but not least, emerging markets, from a valuation perspective now, are looking quite attractive relative to developed markets. Since 2011, emerging market equities have effectively gone sideways, whilst developed markets equities have done very well. So from a valuation perspective now, emerging markets are starting to look more attractive as well.
And your third investment tip today is actually a risk, isn't it? It's a warning.
Yeah, so I've been talking about this for a very long time, about the gilt dilemma. So typically, cautious and defensive investors have held a large allocation to gilts. Given where yields are, we think you're going to see volatility in particularly the gilt market, but also in other bond markets. So I think it's really important to diversify your safety assets across different geographies. We've learned that since 2008, even safe government bonds can get downgraded. The US, the global kind of engine room of the world, has been downgraded. France has been downgraded. The UK has been downgraded. So even safe government bonds have been downgraded. So it's really important to diversify those safety assets. The second thing is you have to be active in terms of asset allocation to take advantage of this volatility, and not just active in asset allocation in traditional bond holdings, but not just hold gilts, not just hold corporate bonds, but hold emerging market debt, high yield, global credit, short duration bonds, and really use the full flexibility of the full fixed income toolkit.
They sound like more risky options within the bond market, though. Is that correct?
Some of those are, I'd say, return seeking within the bond portfolio, but also some of them are kind of safe assets. So short duration corporate bonds, for example, as you start to move into lift-off in terms of interest rates, they will provide protection in your bond portfolio.
Suppose it's taking like an equities approach to bond investing.
I would say it's more just using the full flexibility of the fixed income toolkit.
Justin, thank you very much.
Thank you.
This is Emma Wall for Morningstar. Thank you for watching.